Let's bring in Ben LeBrun, who joins us from the Australian Stock Report, who's live from our Sydney CBD studio. Just to get your take on today's session, Ben, and I know that we've spoken time and time again about the fact that we're still in this very tight trading range at the moment. We don't seem to be breaking out at this point, all watching and waiting to see whether that catalyst might be reporting season. But look, just before I guess we get to that, what did you make of today's trading session? Certainly weaker at the low point of the day.
Yeah, probably not to be unexpected, the performance that we did see today. You're right to mention that trading range, because we do need a serious catalyst to push us through 6,300. Again, we knocked our head on it yesterday and tumbled back down, and we find ourselves right smack bang in the middle of that 6,200 to 6,300 point range. I mean, it's great if you're a trader, because you can just short with plenty of confidence at 6,300, and you generally only have to wait 24 hours before you're in the money. And ditto when we get closer to 6,200, we just always seem to springboard back towards at least the middle of the range, but usually towards the top end. So, I mean, that catalyst that you mentioned, of course, potentially can be earnings season. And I guess a reason why we don't want to push through 6,300, it's hard to argue with this, and everyone's been talking about it, is the fact that price to earnings multiples at these levels, ex-financials, especially in that industrial space, ex-financials is about 26, 27% over its historical average. So why would you push the market? Why would you go like a bull at a gate at these levels, or the 6,300 point levels, when you're probably not getting a bargain at this stage, and you've only got to wait a couple of weeks to get confirmation of the stocks that you might have on your watch list that you might want to chase up. So look, we're hoping that once we get through earnings season, I guess the dog days are over, and we can push into fresh, clear air above 6,300 points. But it's a bit of a fingers crossed story at the moment. So confirmation is what we need. It was a red letter day right across Asia today. But am I surprised? No. Is there any real new news out there outside of maybe Rio Tinto's earnings? Not particularly. I mean, we had all the news that we needed to know when we came in for work at the Open yesterday, with Trump still talking a big game about those tariff wars. So watch this space.
So Ben, in terms of your positioning heading into reporting season, are you saying that you're basically sort of not doing anything at the moment? You're sitting on your hands until we get through it, and then decide on what perhaps new opportunities become available?
Absolutely, yeah. We've been recommending to clients that they lighten their exposure ahead of this crucial earnings period. I mean, and we're being backed up. It's not just us that's saying it. I mean, I think it's a general consensus across the market. I'm pretty sure I saw Magellan the other day say 20% cash is a sensible level to have yourself in at the moment. And of course, in earnings season, these opportunities come up on a daily basis. Stocks are sold off for no good reason, stocks rally for no good reason, and sometimes it represents an opportunity on either side. So definitely, and it's not any sector in particular, it's across the board that we're recommending a little bit. If you've got some profits, take some profits, especially in those nosebleed multiple sectors of the market, i.e. the healthcare sector, the IT sector, what I call the usual suspects. That's a perfect place to maybe just lighten your exposure a little bit, because you don't want to be carrying the baby when the ship potentially goes underwater. Again, I can't say much more than watch this space, because we're only going to have to wait another couple of weeks before all our answers will be found.
Yeah, exactly. You seem to be agreeing largely to.
Well, we saw a case in point of that, of course, with the Rio announcement last night.
Yeah.
That when the UK market opened, it was immediately down 2%, and it was a bit more than that by the end. And of course, it caused knock-on selling as well in some of its compatriots in that space. And we'll get a similar sort of story on the 8th when CommBank's result come out. But if it's half reasonable, well, people say, okay, yeah, well, we might just snug them a little bit higher, and in confidence that they're going to retain their dividends, and things are not that bad from a bad debt side of things, as a simple example. And these are the signposts people are waiting for to see what to next. And obviously with the banks you don't get much of a guidance statement, but the issue is we want to see proof that they haven't deteriorated over the more recent times in what has been for banks, and ditto for mining guys from time to time, tough conditions on and off.
Can I pick up on your point then around Rio Tinto, because I would like to talk a bit about that today, Lawrence, and the sell-off down 4.9% into the end there, $77.65, and as you say, it really followed that weakness from London and the US overnight. but it was a great dividend, a record payout for the company as well. It seemed like the market, though, still wasn't happy enough. Was it that disappointing?
Yeah, I think if you were to look at it, you have to throw in the context that it's run up so nicely. I think the 52-week highs around that sort of 87 mark, and it's a business where you feel that if you're a long-term shareholder, I think you can be optimistic. I think that there are, a retracement, because obviously the market was expecting even better, but the dividend's very encouraging. Obviously, some of that buyback is a question mark, but net, I think materials is an interesting space right now, and I think buying Rio below 80, you might be quite pleased.
I think the issue was people, when it comes to share buybacks and all this, well, it's mainly the UK share this time round. The issue with these sorts of periods when there's a hope of capital initiatives, it's never quite enough people for the instant gratification they were anticipating. But as well as that, there were some issues within the result. There were some cost pressures I don't think people were quite expecting. You could join the dots perhaps and say, well, energy prices have been going up, so perhaps it might impact them. But as well as some legacy issues in areas like the aluminium business, which were front and centre, and markets react to those sorts of new bits of information, small beer as though they might be, in terms of right here, right now, and where they're going over the next 12 months.
Yeah, well, I think that's the big question about growth as well. Where will they see that growth over the next 12 months or so? Ben, your thought? Obviously, capital management and return to shareholders is the big focus of this result. But Tony also rightly points out those cost pressures. I was looking at a note today from UBS saying that rising costs will eventually eat into their earnings in the next few years. Is that something that you might be concerned with Rio about going forward?
Well, this could be the tip of the iceberg when it comes to a thematic playing out in earnings season, and that is in particular rising energy costs. Now, Rio Tinto flagged it, so if they're flagging it, goodness knows who else is going to flag it, especially, if we focus in on the industrial space outside of the materials sector here in Australia, because we know energy costs is a big political issue at the moment. Obviously, we want to see AGL and Origin Energy and what they have to say in terms of their outlooks as well. So, yeah, I mean, that becomes problematic, and I know Fortescue wasn't down as much as BHP or Rio Tinto, but of course they didn't have any news today. But I mean, the costs can't be, you can't continue to take costs out of the business. Once you trim away the fat, you're into the flesh. Once you trim away the flesh, you're into the bone. And how much of the bone can you start cutting? Well, the answer is not a lot. So the cost versus revenue, cost rising at a faster pace than revenue. Is it cause for alarm? Well, I think, one swallow doesn't make a summer, but, that certainly the gauntlet might have been thrown down today. And if we see that continue into the second half and the first half after that, so this time next year, it might become, a significant issue for them. But, there's been a lot of technology. They've spent a lot of money getting technology up to a really good level now where costs are being optimised. So obviously, we're past the point of the bell curve now, so it's costs potentially are a little bit of an issue, but it was still a pretty good number. I mean, I know the headline number certainly did miss. The brokers, including it, I mean, it's still one of our preferred picks, definitely in the mining space. But I did take note of everyone that follows the stock that it's across the board. It's still pretty much a buy or an outperform recommendation across the broking fraternity. And as I said, we do like it as well. So obviously, capital management feeds through into a lot of that, and that's expected to continue with further asset sales down the pipe.